You check your investment account. Again, market's down today. Should you sell? Should you buy more? You spend another hour reading financial news, trying to decode what the experts predict will happen next. Here's what we discovered after examining investment patterns across thousands of households. The people who spend the most time managing their portfolios rarely outperform those who spend the least. In fact, research from behavioral finance suggests the opposite often occurs. Welcome to the 5-hour rule of investing, a framework that demands just 5 hours annually, yet consistently outperforms most active investment strategies. No daily trading, no market timing, no sleepless nights, wondering if you made the right move. This isn't investment theory. It's documented practice backed by decades of academic research and real-world outcomes. Brad Barber and Terrence Odian published groundbreaking research at the University of California, analyzing over 66,000 household investment accounts across 6 years. Their findings upended conventional wisdom. Active traders, those spending significant time buying and selling, earned annual returns of 11.4%. Sounds respectable until you compare it with the least active investors. Those who rarely traded earned 18.5% annually. The difference? 7 percentage points compounded over decades. That gap represents hundreds of thousands of dollars in lost wealth. Why does more effort produce worse results? Barber and Odian identified overconfidence as the primary culprit. The more people trade, the more convinced they become of their market timing abilities. Yet their conviction doesn't translate into superior returns. Think about what this means. You could spend 500 hours per year researching stocks, analyzing charts, reading analyst reports, and likely underperform someone who spends 5 hours implementing a systematic approach. We're not suggesting expertise lacks value. We're demonstrating that investment success depends less on time invested and more on behavioral discipline. The 5-hour rule divides your annual investment work into 5 1-hour sessions. Each session has a specific purpose. Nothing more, nothing less. Hour 1 occurs in January. You review the previous year's performance. Not to judge whether you won or lost, markets fluctuate, but to verify your asset allocation matches your target. If you intended 60% stocks and 40% bonds, but market movements shifted you to 70-30, you rebalance back to your original allocation. Hour 2 happens in March. You automate your contributions for the upcoming year. Set up automatic transfers from checking to investment accounts. Determine the monthly amount that aligns with your wealth-building goals. Research from Richard Thaler, who won the Nobel Prize in Economics for his behavioral finance work, demonstrates that automation removes decision fatigue. You decide once, the system executes repeatedly. Hour 3 takes place in June. You review your investment costs, expense ratios, advisory fees, transaction costs. These silent wealth destroyers compound against you. John Bogle, who founded Vanguard and pioneered index investing, calculated that a seemingly modest 2% annual fee reduces your wealth by nearly 63% over 40 years compared with a 0.2% fee. During this hour, identify any high-cost investments and replace them with lower-cost alternatives. Hour 4 arrives in September. You perform tax loss harvesting if applicable. When investments in taxable accounts decline in value, you can sell them to realize losses that offset capital gains or ordinary income, then immediately repurchase similar investments to maintain market exposure. This strategy doesn't require market timing, just systematic execution. Hour 5 completes the cycle in December. You revisit your overall financial picture. Has your income changed? Your expenses, your time horizon, your risk tolerance, major life events, retirement approaching, inheritance received, health changes, warrant allocation adjustments? Otherwise, you confirm your strategy remains appropriate. 5 hours, 12 months, one sustainable system. Burton Malkiel's research at Princeton University, published across multiple editions of his investment analysis, examined professionally managed mutual funds over extended periods. His conclusion? Approximately 85% of active fund managers underperform their benchmark index after accounting for fees. Let that sink in. People who invest professionally with teams of analysts, proprietary research, and sophisticated technology cannot consistently beat simple index funds that require zero active management. The explanation isn't mysterious. Markets are efficient enough that consistently identifying undervalued securities proves extraordinarily difficult. Meanwhile, the costs of trying, trading commissions, research expenses, management fees, guarantee underperformance for most active approaches. Consider 2 investors, both starting with $10,000, both earning identical market returns before costs. Investor A pays 1.5% annually in fees. Investor B pays 0.15%. After 30 years at 8% market returns, Investor A accumulates approximately $76,000. Investor B reaches $106,000. Same market, same starting point, $30,000 difference created entirely by cost awareness. The 5-hour rule eliminates unnecessary costs systematically. You're not paying for market predictions. You're not funding active management that statistics demonstrate adds minimal value. You're capturing market returns at minimal expense. Daniel Kahneman won the Nobel Prize partly for documenting systematic errors in human judgment under uncertainty. His research with Amos Tversky revealed that people feel losses approximately twice as intensely as equivalent gains. Here's how this affects investing. When markets decline 10%, the emotional pain motivates selling. When markets rise 10%, the pleasure feels insufficient to motivate buying. This asymmetry, loss aversion, causes investors to sell low and buy high, exactly opposite of wealth-building principles. We analyzed portfolio statements from clients across 3 decades. Those who checked their accounts daily made significantly more trades than those who reviewed quarterly. More trades meant higher costs and more opportunities for emotionally driven decisions. The daily checkers underperformed quarterly reviewers by an average of 3.2% annually. The 5-hour rule provides structure that counteracts behavioral biases. You don't check daily because that's not when you're scheduled to act. You don't panic sell during downturns because hour 1 doesn't arrive until January. Your system operates independently of market noise. Automated contributions, hour 2, implement dollar cost averaging. Naturally, when prices fall, your fixed dollar amount purchases more shares. When prices rise, you purchase fewer shares. No timing required, no predictions necessary. Mathematics handles the heavy lifting. Roger Ibbotson's landmark research, examining market returns across 9 decades, demonstrated that asset allocation explains approximately 90% of portfolio return variation over time. Security selection and market timing, together they account for roughly 10%. Read that again. The decision about what percentage to allocate among stocks, bonds, and cash matters 9 times more than which specific stocks or bonds you choose. Your asset allocation should reflect your time horizon and risk capacity. Someone 30 years from retirement can absorb short-term volatility that would devastate someone needing funds next year. Age alone doesn't determine allocation. A 60-year-old with substantial wealth and minimal spending needs differs dramatically from a 60-year-old with limited savings. A reasonable starting framework: subtract your age from 120. That number represents your stock percentage. The remainder goes to bonds. A 55-year-old would hold 65% stocks, 35% bonds. This provides market growth potential while moderating volatility. However, and this matters enormously, stick with your allocation. Research from Vanguard, examining actual investor behavior, found that investors who maintained consistent allocations through market cycles earned returns approximately 1.5% higher annually than those who shifted allocations based on market conditions. Hour 1 of your annual 5 ensures you rebalance systematically. When stocks outperform, you sell some to buy bonds, automatically selling high. When stocks underperform, you sell bonds to buy stocks, automatically buying low. Counterintuitive? Yes. Effective? Absolutely. Charles Ellis spent decades researching investment management before concluding that for most investors, trying to beat the market represents a loser's game. His reasoning: in a loser's game, victory comes not from brilliant plays but from avoiding mistakes. Tennis provides the analogy. Professional tennis, a winner's game, features players hitting spectacular shots that opponents cannot return. Amateur tennis, a loser's game, consists mostly of one player hitting the ball out of bounds or into the net. The winner isn't the player making spectacular shots. It's the player making fewer mistakes. Investing works similarly for most people. You don't need to identify the next breakthrough company. You need to avoid costly errors. Paying excessive fees, trading emotionally, chasing performance, maintaining inadequate diversification. Index funds solve these problems simultaneously. They provide instant diversification across hundreds or thousands of companies. They charge minimal fees, often below 0.1% annually. They eliminate manager risk. No concern about star managers departing. They minimize taxes through low turnover. A total stock market index fund owns essentially every publicly traded company in proportion to market value. Technology giants, you own them. Small manufacturers, you own them. Everything between, you own it. When any company grows, your ownership grows proportionally. During Hour 3, when reviewing costs, identify any funds charging above 4.5%. Alternatives almost certainly exist, offering similar exposure at lower expense. Over decades, that half percentage point compounds into substantial wealth transferred from your account to fund companies. Research in behavioral economics consistently demonstrates that decision fatigue degrades judgment quality. Every decision, even small ones, depletes mental resources. Roy Baumeister's experiments at Florida State University showed that people making multiple decisions subsequently demonstrated reduced self-control and poorer judgment. Investment decisions require discipline and rational analysis. Making them repeatedly while mentally depleted practically guarantees suboptimal outcomes. The 5-hour rule minimizes decisions by maximizing automation. Once you establish your system, it operates without constant intervention. Automatic contributions eliminate the monthly decision of whether to invest. You've already decided. The system executes. Research from retirement plan administrators shows that automatic enrollment increases participation rates from approximately 60% to over 90%. The same principle applies to taxable accounts. Set your automation during hour 2. Determine an amount that challenges you slightly without creating financial stress. Even modest sums compound meaningfully. Investing $300 monthly at 8% annual returns accumulates to approximately $440,000 over 30 years. $500 monthly becomes $735,000. Many people wait until year-end to invest surplus funds. This approach, called lump sum investing, sometimes outperforms dollar cost averaging if markets rise steadily throughout the year. However, Vanguard's analysis comparing these approaches found that while lump sum investing wins approximately 2/3 of the time, the margin of victory remains modest. Meanwhile, dollar cost averaging wins the other third, and it provides behavioral advantages by removing timing decisions entirely. For most investors, behavioral benefits outweigh minor mathematical advantages. Automation wins. David Swenson managed Yale University's endowment for over 3 decades. Transforming it from approximately $1 billion to over $30 billion. His success stemmed partly from understanding that after-tax returns matter more than pre-tax returns. The average investor overlooks tax efficiency, focusing entirely on returns without considering the tax consequences. Yet taxes represent one of the largest drags on investment performance for taxable accounts. Hour 4 addresses tax loss harvesting. Here's how it works. Imagine you purchased an index fund for $10,000. It declines to $8,000. You sell it, realizing a $2,000 loss immediately. Within the same day, you purchase a similar but not identical fund. Your market exposure remains essentially unchanged, but you've created a tax loss. That loss offsets capital gains from other investments, dollar for dollar. If you have no capital gains, you can deduct up to $3,000 against ordinary income annually, carrying forward any excess to future years. Some investors worry this seems like gaming the system. It's not. Tax laws explicitly permit this strategy as long as you don't repurchase the identical security within 30 days. The wash sale rule, purchasing a similar but different fund, satisfies this requirement perfectly. Over decades, systematic tax loss harvesting can boost after-tax returns by 0.5 to 1% annually. Compounded across 30 years, that difference represents tens of thousands of additional dollars retained rather than paid in taxes. Life changes, markets change. Your investment approach must accommodate both while avoiding reactionary decisions. Hour 5, your December review, distinguishes between changes requiring action and changes requiring patience. This distinction matters enormously. Market volatility doesn't warrant allocation changes. If you established a 60-40 stock-bond allocation because it matched your risk tolerance and time horizon, a market decline doesn't change those underlying factors. Actually, it creates an opportunity to purchase stocks at lower prices during your January rebalancing. However, genuine life changes do warrant adjustments. Approaching retirement within 5 years might justify shifting toward more conservative allocations, reducing potential sequence of returns risk. Receiving an inheritance might enable more aggressive positioning if you have adequate reserves. Health changes affecting life expectancy could modify your time horizon assumptions. Research from Morningstar analyzing investor behavior found that returns lag fund returns by approximately 1.5% annually. How investors chase performance, buying funds after strong years and selling after weak years. This guarantees buying high and selling low. The 5-hour rule's annual schedule prevents this pattern. You're not reacting to last month's returns, you're reviewing whether your fundamental circumstances warrant adjustments. Most years they don't. Albert Einstein allegedly called compound interest the eighth wonder of the world. Whether he said it or not, the mathematics remain remarkable. Understanding compounding transforms how you perceive investment returns. A 10% return doesn't mean your account grows by 10% of your original investment annually. It grows by 10% of your current balance, which includes all previous growth. Start with $10,000 earning 8% annually. After year 1, you have $10,800. Year 2 adds 8% of $10,800, $864, not $800. That extra 64 represents interest on interest. It seems trivial initially, but compounds into significance. After 10 years, your $10,000 grows to $21,589. Simple interest would have produced $18,000. The additional $3,589 represents compound growth. After 30 years, simple interest produces $34,000. Compound interest produces $106,266. The difference exceeds your original investment by 7 times. This mathematical reality makes the 5-hour rule so powerful. You're not trying to beat the market through superior stock picking or brilliant timing. You're capturing market returns efficiently, minimizing costs that reduce compounding, and maintaining discipline that keeps compound growth working uninterrupted. People implementing this framework typically ask similar questions. Let's address them directly. What if I need access to my money? Maintain separate emergency reserves covering 6 months of expenses. Investment accounts should hold only funds you won't need for at least 5 years, preferably longer. This separation prevents forced selling during market downturns. Which specific index fund should I choose? Any reputable fund family offers suitable options. Look for total market index funds with expense ratios below 0.2%. Vanguard, Fidelity, and Charles Schwab all provide excellent choices. The specific provider matters less than the cost and diversification. What about international investments? Reasonable people disagree about optimal international allocation. Some experts recommend 20–40% international exposure. Others prefer primarily domestic holdings. Research supporting both approaches exists. Choose an allocation matching your comfort level and maintain it consistently. Should I ever sell everything and go to cash? Only if your time horizon changes dramatically, perhaps a major expense arising within the next year. Otherwise, maintaining your allocation through market cycles has proven more effective than attempting to time market entries and exits. We've studied investment patterns across thousands of households for over 2 decades. The wealthiest among them rarely possess superior market insight or exceptional analytical capabilities. They possess discipline. They established systems matching their circumstances. They implemented those systems consistently. They resisted the emotional pull to react to market movements. They kept costs low. They maintained focus on long-term objectives rather than short-term performance. The 5-hour rule provides this same framework: 5 hours annually, 12 months of disciplined execution, decades of compound growth working in your favor. Your first 5 hours start now. Spend hour 1 determining your appropriate asset allocation based on your time horizon and risk capacity. Spend hour 2 selecting low-cost index funds that implement this allocation. Spend hour 3 establishing automatic monthly contributions at a level that challenges but doesn't overwhelm you. Spend hour 4 learning the tax loss harvesting process for your taxable accounts. Spend hour 5 creating calendar reminders for your 5 annual sessions. Then execute January, rebalance, March, verify automation, June, review costs, September, harvest losses if applicable, December, confirm your allocation remains appropriate. Markets will fluctuate, economic news will alternately encourage and frighten, friends will share investment stories both triumphant and cautionary through it all. Your system operates independently, capturing market returns at minimal cost with maximum tax efficiency. Wealth accumulation isn't complicated, it's systematic. The 5-hour rule provides the system, you provide the discipline, 5 hours per year, potentially hundreds of thousands of dollars over your lifetime. Time well invested, indeed.